In 2025 alone, Berkshire Hathaway, under Warren Buffett, became a net seller of stocks to the tune of tens of billions of dollars, with over $24 billion in net equity sales through the first 9 months, and continued selling into Q4. For millions of everyday investors, that wasn't just a headline, it was a red number on their screen, especially in major tech and banking holdings. So here's the uncomfortable question. When the most respected investor in history starts quietly stepping back, who feels it first? It's like the captain leaving the crowded side of a boat before the weight shifts. In markets, that's called liquidity asymmetry, and the consequence is simple. Smaller investors absorb the first wave of volatility. Here's what happened. Retail investors holding major tech and banking stocks saw immediate paper losses as Berkshire trimmed massive positions. Over 75% reduction in Apple shares since mid-2023, including continued sales of approximately 10 million shares in Q4 2025 alone. Nearly 50% cut in Bank of America since mid-2024, with approximately 51 million shares sold in Q4, and a dramatic 77% slash in Amazon stake in the final quarter. Nothing illegal, nothing dramatic, just steady, calculated selling. It sounds reasonable, but here's the problem. When a large shareholder like Berkshire reduces exposure on this scale, it increases supply significantly. More supply without equal demand pushes prices down. If you're leveraged, using margin, that drop can trigger forced selling. It's like dominoes placed too close together. In finance, that's called leverage amplification. And the real-world consequence? Losses accelerate faster than expected. Employees in supply chains, banking operations, and tech services felt secondary effects. When share prices fall, companies cut costs, hiring slows, layoffs begin. Who pays first? Usually not the institution sitting on a record cash pile exceeding $380 billion, reaching approximately $382 billion by late 2025, mostly in cash and short-term treasuries. The selling wasn't chaotic. It was gradual, quarter by quarter. 13 straight quarters of net stock sales by end 2025. Why? Because rising interest rates make future profits worth less today. When borrowing costs rise, high valuation stocks become more fragile. It's like adjusting the brightness on a screen. Turn down the light, and the glow fades instantly. In markets, that's called rate sensitivity. The consequence? Growth stocks reprice quickly. Here's where it gets interesting. The capital wasn't disappearing. It was moving towards steadier cash flows, building positions in insurance, like Chubb, energy, Chevron, consumer staples, Domino's Pizza, and even a new approximately $352 million stake in the New York Times. Meanwhile, cash reserves ballooned to historic highs. That's not panic, that's repositioning, and the system rewards repositioning early. For over a decade, cheap money encouraged expansion. Companies borrowed cheaply, investors chased growth, valuations expanded. When money is easy, risk hides. It's like building taller buildings on softer soil. In economics, that's capital mispricing. The consequence? When conditions change, the tallest structures shake first. Margin debt across the industry reached historic highs. Derivatives amplified bets on permanent growth. Regulators could see parts of it. Institutions definitely could. But retail traders? Many were reacting in real time. And here's what most people miss. Large institutions don't need to predict collapse. They only need to reduce exposure before everyone else reacts, as Berkshire did, quietly trimming Apple, still the largest holding at approximately $60 billion plus post-sales, Bank of America, and slashing Amazon while the market focused elsewhere. The system rewards those with liquidity, patience, and optionality, not those with urgency. Now we go deeper. Why does this keep happening? Because markets are structured around capital preservation first, opportunity second, if you're large enough. When you control massive cash reserves, over $380 billion in Berkshire's case, downturns are flexibility. When you're fully invested, downturns are danger. It's like playing poker with a deep stack versus your rent money. In financial terms, that's risk tolerance asymmetry. The consequence? One player waits comfortably. The other folds under pressure. Was the shift malicious? No. Was it rational? Yes. That's precisely the point. The system encourages early movers to reduce exposure when conditions tighten. It does not encourage equal warning time for everyone else. Narratives frame these moves as prudence or diversification, and often that's true. But structurally, it creates a pattern. Early repositioning by the largest capital holders, volatility absorbed by leveraged participants, assets reconcentrated in stronger hands. Not because anyone is evil, because incentives point that way. After the dust settles, concentrated capital often emerges more resilient.
Cash positions increase to record levels, risk exposure narrows, strategic sectors gain weight. Meanwhile, leverage doesn't disappear. It migrates, sometimes into commodities, sometimes into derivatives, sometimes into private credit. Fragility doesn't vanish, it relocates. And the next cycle begins building quietly inside the solution to the last one. The event fades, headlines move on, prices recover, narratives reset. But the underlying incentive structure, early exit, liquidity advantage, capital migration, remains intact. Markets don't reward morality, they reward positioning. Cycles are not accidents. They are expressions of incentives operating over time. Capital seeks safety the same way water seeks lower ground. It moves silently until pressure changes direction. The disciplined observer doesn't obsess over personalities or headlines. They study structure, because in every era, the visible crisis passes, but the architecture that directs capital and determines who absorbs shock first endures. And markets follow incentives the way gravity follows mass.